It's a pleasure to see everybody. You ready to get started?
Sure.
Okay, great. First thing I want to say is that thanks for being here tonight. I know there's a million other things you could be doing, with family, with friends. Good thing it wasn't last night because you'd be watching the election. And my name is Michael Gray. I'm the Business Development Director at Grassi. And this is Pete Grassi, the man himself, owner of the firm. And we're here to talk about investments. And I want to say up front that this time is for you. It's not for me because I know this stuff. So interrupt us at any point with questions. If you're wondering how the election results are going to affect the economy and the investment world, he has all the answers.
All right.
Do you want to say a couple words, or you want me to just jump in?
Well, I just want to, thank you very much for coming. I'm Pete Grassi. Just kind of reiterate what Michael said. We're here actually to tell you a little bit about the firm, what we do, how we can help you. A little history on us, and navigating the markets is a torrential landscape these days. Because I've been in business 36 years, so I've been around for some time, and hopefully this could help you a little bit, possibly in managing your own funds. One of the great things about our firm is that we have no conflict of interest. I come from Wall Street, and I've been in a lot of the kitchens there, so I know exactly what goes on at Merrill Lynch or UBS or Smith Barney or any of the other firms that are out there. They're there to sell you a product. They're there to make money. They're there, to enhance themselves most of the time, not the client. On the other hand is that we have no conflict of interest. We're not a commission-based, we're a fee-based advisor. Basically our goal is really a long-term relationship with the client. Look at the ADV form that we file with the SEC. It shows that our clients stay with us for a long period of time. And one of the reasons is that it's a relationship business. It's a trust. So, that's part of the whole thing. Everybody's selling kind of the same thing, but what's the difference? The difference is that you've got somebody that has your interest first before theirs. Two is that you have a firm that you build up a relationship with over time. And three is the safety of your money. What's my money doing? Where's it at? I got it at XYZ or wherever the case may be, but a lot of times is you have bad experiences, you change firms, they didn't listen to you. So we're here tonight to maybe explore a little bit more about that, how we do it, and possibly I'm here to answer any questions that you have. I don't have all the answers. If I did, I wouldn't be here. But just to kind of give you a little bit of background, I've been in the business 36 years. Grassi Investment Management was started by my father in 1983. In 1982, we were with a small regional brokerage firm in San Francisco, and we got bought out by Shearson & Lehman, a big Wall Street firm. And then we went through the M&A with Hutton and with, there's Hutton and Lehman, and then we came full pace with Smith Barney and Citigroup, and that's when we left the firm in 2000 and formed a relationship with Charles Schwab. Charles Schwab is our main custodian, and we were lucky enough to be one of the SAND advisors in their program, which they pick about maybe 15 investment advisors to help their clients through a referral program. So from a compliance standpoint, you're very lucky because we've been pre-screened compliance by Schwab, and we also have our own compliance department too. We're a registered investment advisor with the SEC. So other than that, I'll let Michael tell you a little bit more about, some of the slide presentations, and I'll kind of kick in from here.
Okay. So I'm just gonna elaborate on something Pete said about conflict of interest. And what I've noticed is you almost need to be in the industry to know enough to know how not to be taken advantage of. And so it's just, it's so complex, all the details. And I'll give one example. So if you're being sold a mutual fund, in some cases the advisor is paid more for selling you mutual fund A versus mutual fund B. So which mutual fund are they going to recommend you? A, right. So we don't have that conflict of interest because we're only paid by our clients. There's nobody else paying us, and we buy individual stocks and individual bonds, as you'll want to know. So we're going to talk about Grassi. We're going to talk about financial planning. Again, this time's not for me; it's for you. So stop me with questions. Hey, what about this? What about that? Okay, so as Pete said, we've been in business more than 30 years. We manage about $750 million. We use Schwab, which is the biggest custodian out there. In my mind, my money's at Schwab too. If it's at Schwab, it feels safe to me. Since Bernie Madoff in 2008, there's a lot of scandals, and so Schwab has really upped their game to make investors feel secure about where their assets are. We serve institutions and high net worth individuals like yourself. We're led by Pete Jr. and his father, Pete Sr. And as Pete said, he brings a lot of experience. So Pete makes my job easy because I go out and talk to people. And so I don't have to worry about Pete panicking, like, when something surprising happens. Did something surprising happen recently? Yeah. So, because
Shocking, actually.
Yeah, because Pete's been through that. He's been through the '87 crash, the 2000 internet crash, the Mexican debt crisis, and so I don't know if I could make him panic if I tried. But he doesn't seem to be the panicky type to sell, when the markets are down, which is you don't want to do that. And in terms of fees, what I mean by one layer of fees, I'll go into that in more detail. But we hold individual stocks and individual bonds, so there's no extra fees like you would get from a mutual fund. Okay, our first goal is a lot of listening to you and what's important to you. So is your goal income? Is it capital preservation? Is it growth? Some combination. That's kind of the first step. And as Pete said, we're looking for an ongoing relationship. So that means a lot of communication. And I think in my experience with a lot of communication comes more trust that builds over time. And so that's valuable. And we have some financial planning software that I'm going to show you in a sec, called Money Get Pro. Anybody know what financial planning is? Noreen, do you want to tell us?
Well, you try to line up what your assets are and your portfolio and balance it in a way that represents large, small, secure, more risky.
Yeah. So the primary question in financial planning is, do I have enough money for the goals that I want to reach for my expected lifetime? Which we never know how long we're going to live. But, we do the best with what we have. And so that's what this software does. And we're going to work with, if you have accountants and attorneys that you already work with, we're glad to work with them as well as partners. Okay, high quality, risk adverse. I was talking with Chris before we started. I think what Pete brings to the equation is a lot of experience and a focus, first of all, on preserving your money. So what's the first rule of being a doctor?
Go to school.
Do no harm, right? Hippocratic oath. So what would be a similar rule for an investment advisor?
Don't lose any money.
Don't lose any money.
There you go.
This man is good at that.
There you go,
So
Chris.
he's been in the business a long time, and so our first goal is preserving what you have and growing it conservatively over time. So that's the game we're playing. We have 4 different strategies, from all stocks, 2 strategies that have stocks and bonds, and then 1 strategy that's all bonds or fixed income. And we customize it to whatever you're looking for. Jing, would you say you're looking for growth or income or
All the above.
all of the above? Yeah, where most investors say, don't lose any of my money and just grow it as quickly as possible. Yeah. As I said, we use individually owned stocks, and we use a bond ladder. So long-term outlook, low annual turnover,
What's a bond ladder?
bond ladder, great question. Is that you, Diane?
Yes.
Okay, so a bond ladder is, let's say you have 10 bonds, and you have 2 mature this year, and then 2 mature next year, 2 the following year, like that. So you have, say, 5 years worth of bonds. And so every year, one of those bonds comes due, and so you have cash coming back in. And if interest rates rise, as everybody's predicting, then as you have that new cash, you can reinvest it at a higher interest rate. Or if you want to remodel the kitchen or go on a trip, you have cash sort of coming in on a regular basis.
It's like a CD ladder, where you have different maturities, except they're in corporate bonds or tax-free bonds. So say if somebody sells their company and they have $20 million, okay, you got $20 million, I don't really need much more. What do I do with the $20 million? Well, some people want to make it 40 or 100, so they want to, gamble. If you got $20 million, some people might just say, look, I want, what's as conservative as you can get. You can do a bond ladder of tax-free bonds, and say you get 2% as an average in the ladder. That would be basically, if you're you get a tax-free ladder, you're in the 50% tax bracket. That's like a 4% return. So what you do is you stagger the maturities. The income comes in, you live off the income, it preserves the capital, and it's, send me a check, and I'm going to be in the Caribbean for the rest of my life. So that's what a bond ladder is. What's the risk? The risk is when interest rates start to go up, the price of your bonds come down, but if you have individual bonds, it doesn't really matter. When they come due, you get paid the full $100,000 or $200,000, whatever you have in it, even if the price of the bond. In a mutual fund, tax-free mutual fund, you see them all over the place. And you got Naveen, you got tax-free bond funds, whatever the case may be. If you put $100,000 or $1 million or $100 million in one of these funds, when the price goes up, the fund goes down in price. I mean, when interest rates go up. So what happened is that, now I want to sell, you're going to sell it at a loss, because it's a fund that's just continuously buying bonds. It's not customized towards your needs. So those are the risks that you have to find out. When I started in the business, interest rates are at 15%. They're at 1 today, or less. So you've seen the bottom of the interest rate market after 36 years. It's going to start to come back slowly. It's going to come back up a little bit. You're not going to see this for a long time, but you can see another 3 to 4%. So it will affect interest-sensitive investments over time. So that's, part of the deal with us is you get a little bit of an education in the investments, so you learn a little bit, about it. So at least you know what it is and what's going on with it a little bit. But that's what a bond ladder is. It can be taxable or tax-free.
Thanks, Pete. So we talked a little bit about financial planning. This is the software that we use. I think, Maureen, you may have seen this already.
Yeah.
So we have our hypothetical client here. We have Anna and Ivan with their retirement ages and their current spending over here. And they have a 23% chance of success of having enough money for how long they live, given their current spending and how much money they have. Does that make sense? Okay, so I've gathered here a panel of women investors to help out these folks. So what would you recommend in terms of changing their retirement age or their spending to get that probability of success to be higher? You understand that question?
Yeah. What is it? I can't read it.
So they have a 23% chance of
Yeah,
having
but
enough
what are
money.
their retirement ages?
Retirement age right now is 64
Oh, okay.
and 62. So should they retire sooner or work longer? Okay, there we go.
There you go.
Okay, so let's have Anna work a couple of extra years, see what happens here. Okay, so we've gone from 23 to 44, that's good. Ivan, let's add a couple years for him. We'll go from 44%, oh, 56%. Okay, and they're gonna move to Sacramento from Los Altos, so will their expenses go down? There we go, let's see what happens, we bring them down from 90 to 78. Oh, we're in the green. Good, yeah, does that make sense? It's, what I love about the software is it's so intuitive. You know, it's pretty simple to adjust the levers and, you know, we can't predict the future, and this has assumptions about inflation and investment returns, and your expenses grow with inflation. But we can kind of get an idea, you know, going forward, whether we're way off base or we're kind of on target. Jeff? Any other questions before I go on to the next?
And that's assuming a fixed rate of return,
Exactly.
because I would have just said, well, put your money in higher payback rate, earning rate, that's,
Right. So, yeah, so if you're
I
all
don't
in.
wanna retire that late.
Exactly, yeah. So there's a lot of things you can do when working with an advisor, right? So you would tell me, Diane, you know, about how much risk you want to take on. And so we'd find a risk level that's appropriate for you. And then Pete would invest that in a way to meet the goal that you're trying to work with. So we, in combination with the software and with Pete's investment experience, then we'd find something that works. So if you're all in cash, you know, unless you got $100 million or $10 million, it's gonna be hard to meet your goals, right? So as Pete was talking about, a bond ladder is a great way to get consistent, conservative income over time.
But how can the bond ladder be not taxed?
Yeah, so there's these bonds called municipal bonds, which are free from federal taxes and often from state and city taxes as well. So it's a special category bonds. If you have a high income, people tend to like those bonds because of the tax. Yep.
You just voted for a bunch of bonds. They'll be out there now. Transportation bond, they'll be out there.
Okay. I'm gonna go through these relatively quickly, our portfolios, but stop me with questions. So we have a portfolio that's all stocks, 100% stocks, designed to beat the S&P 500, and it's gonna have a similar diversification as the S&P 500. So what's Pete, as I mentioned, Pete's first goal is capital preservation, and so diversifying is a good way to do that. Now, if we add some bonds here, then we're gonna add a little more stability to the portfolio. It's gonna be less up and down than an all stock portfolio. So our balanced portfolio has growth stocks and some bonds. So who can name a couple growth stocks for me? Growth companies. Apple. Sort of used to be considered a growth.
Right.
Yeah. Nowadays less so. What?
Facebook.
Facebook, perfect. Netflix, Google, some of those
What
companies.
about Disney?
Not quite.
Not
No,
quite.
it hasn't
Okay.
been.
More of an income stock?
No,
Conservative?
it's, you know, Disney is moderate.
Yeah, moderate.
It's not a real growth. Growth companies are considered growing at 20% a year. I'd say Disney's a single-digit grower these days.
Which is great, because to me, that's a great example of the expertise and experience that Pete brings. Because if Gene says, I want something more conservative, or I want conservative with some growth, then Pete will say, yes, Disney, or no Disney, or. Okay, income strategy. Deanna, how much is your bank account paying you in interest these days?
Nothing?
Nothing. Okay, so that explains why our income strategy is by far the most popular strategy we have, right? So that's dividend-paying stocks and corporate bonds.
Or tax-free bonds.
Or tax-free municipal bonds, depending on your goals. And then sometimes we do all bonds, depending on what folks are looking for. Okay. GIPS compliance. Has anybody heard of GIPS compliance? I pay you $20 if you've heard of GIPS. Nobody's heard of GIPS compliance, even knowledgeable folks. So all that GIPS compliance means is that we have audited performance numbers. So when we show you that we did 25% investment return, that's audited. We didn't do 25%. That would be a lot of risk. So we have a third-party company up in Oregon that audits the performance numbers that we show you. So when we sit down to meet Diane and you say, how did your investments do, you can know that it's audited. So if you're talking to other advisors, you might check in with them and say, here, are your performance numbers audited or GIPS compliant? And I'll look at you like. So it's a good question. Okay, we have $1 million minimum. And for these strategies and for bonds, it's a $2 million minimum. And our fee is 1% on the first up to 2 million. And then 0.75% from 2 million to 10 million and 0.5% above 10 million. For bonds only, it's 0.5% for the 5 year. Okay, so for those of you who are experienced investors, how much do many firms charge for your advisory management fee, which is very visible to you? You get an invoice, it's quoted to you. What's a typical number there?
Is it 1%?
Yeah, so that's a good number. 1%? Yeah. I mean, there are firms that are less, there are firms that are more, but that's kind of the industry standard. How much do we charge? You just saw it, right?
You said 1%.
1%, okay. So far, so good? Okay. So, now we get to the invisible part. So the cost of the underlying investments that this advisor is putting you in, right? Which tend not to be quoted. You don't get an invoice for the cost of those other investments. Sometimes you don't even know. Sometimes if it's a mutual fund, you can look it up. How much does that cost at many firms? Yeah, it could be, I put a question mark there because it depends, you know, maybe your average actively managed mutual fund is 1%. If your advisor's putting you in hedge funds or private equity, it gets more expensive, 2%. There are cheaper mutual funds as well, so it might be less than 1%. How much is it over here? How much, when you work with Grassi, how much does it cost the investments that we put you in?
No, nothing.
Nothing. Who said zero? Oh, you get a prize. Okay, prize is over there. Why is it zero?
Well, based on the fee schedule, you said you just have a flat fee, you're not commission-based.
Exactly correct. And the underlying investments that we use are individual stocks and individual bonds. So it's not a mutual fund that charges an ongoing fee. You just own the stock, right? Once you buy a stock, then you own it. Yeah. So I'll just say that again another way. Once you've bought Apple stock in your account, how much does it cost for you to keep it there? Nothing. Right. Yeah. So that's.
Excuse me.
Here, go ahead.
So to get out of a mutual fund, is there a penalty fee that you pay?
You could make a whole career out of knowing the complexities of mutual funds.
Sometimes.
And how it works, yeah.
There's
So-
a front load and a back load.
Yeah.
On the front load, they're charging you up front, and then besides charging you up front, they have a management fee like that.
Yeah.
Or it's a back load where, they're charging you a fee, and then when you sell it, it kind of goes down. So yes, there are hidden fees out there that, is basically in the perspective, but most people do not, read that.
Yeah. So if you have the time and expertise to read 30 pages of fine print, you could probably find it in there. Most of us don't.
But then you have to understand it.
And then you have to understand it. So I was working with Katie, who's our operations manager in the back there. We had a new client, and she had a mutual fund that was transferred over, and then there was a $200 charge. We said, what's this? You know,
We had that
3
too.
phone calls, an hour later, oh, it's the back end load of when you sell it and you've held it for less than a year. And, you know, some of these investments, you have to make 5% to get back to 0. You know, to get back to even. So what I like about what we offer at Grassi is a very low cost.
It's transparent.
It's transparent. Because when you buy a mutual fund, you know, it's like making sausage, right? You never quite know actually what's in there. And it can be the same thing with a mutual fund. You don't actually know what's in there unless you have all this time and energy to read through that really long 40-page document to see, yeah?
But also for a mutual fund, when the portfolio manager buys and sells the stock within that mutual fund, you also kind of get dinged because
Capital
there's no
gains.
consistency.
That's right, that's right. So
Right.
we can control your capital gains.
Exactly.
Because in October, usually November, you'll get a statement on capital gains if you just bought it and, you know, what's this? So in our portfolio, we have a P&L at the end of the year, and it's either long-term or short-term gains. So, you know, it's not dependent on a fund at all. So you know that.
Yeah, so we had another client who was interested in working with us for exactly that reason, because she had no control over her taxes, because the mutual fund kept spitting out capital gains. Yeah,
Yeah.
so we can work in with you and your CPA, you can sit there and can tell me, hey, only take 20,000 in capital gains this year. So we can, you know, we can manage
I have
that.
a question, is there a fee for when they put you in, the funds that follow the market?
Yes,
There is?
yeah, there is.
Pretty much every mutual
Everything, it just
fund or
depends, it's either a
ETF.
lower or higher fee. There's ETFs, which are exchange traded
That's
funds,
what I
which are
heard.
lower fees, but there's a fee. When they say there's no fee, what do you think people at Franklin are working for nothing? These mutual funds, they employ thousands of people. They charge, there's a fee on everything that you do, or a commission, period. The guy says there's no commission or no nothing, he's bullshitting you. Okay, so that's a little bit about the investments. I mean, one of the reasons that we give these seminars for women and is a lot of women tend to run the finances in the houses, and a lot of women, you know, when their husbands pass away, they don't know what to do. Like my mother, my father's taking care of the investments all these years, and all of a sudden, she's got $4 million and she doesn't know what to do, who to trust, where to go. You know, where do you go? I mean, what do you do? I mean, I call Merle Lynch, or I do this. I mean, whether you deal with us or anybody else, the most important factor is the relationship that you have with the person. You can trust the people that you're doing it. You know how much you're paying. You get a statement every month. You know, where's my money at? It's at Schwab. Now, not only do you get a Schwab statement, but we also send out we use Advent software, which is an accounting system, quarterly, which you get. So, you know, we're very service oriented. Our performance is audited by an outside auditor. We're local. I've been in the community all my life. I grew up here. I grew up in Menlo Park. I went to Bellarmine College Prep in San Jose, and then from there I went to Berkeley. So I've been around for a long time, and we don't get to be successful to where we're at these days unless, you know, we're pretty good at what we do, but we're conservative. You know, our main goal, we deal with high net worth individual accounts. Our minimum is $1 million, our average account is over $3 million. So people that have the money, you know, preservation of capital, you don't want to lose money. You know, I'm not perfect. Sometimes we'll lose money in a stock, we'll trade out, but you're making money over here, so it balances out over time. And our income strategy this year, up through about 9 months ago, our stocks were up about 10%, our bonds were up about
6%, yeah.
4, 5, 6 maybe, and then our total composite, which is made up of stocks and bonds, was around 7%. So that's the composite is the bottom, is 7%. So you got 10, you know, but if you had all stocks, you'd have 10. Like, you know, if you want to have more aggressive portfolio, We customize the portfolio based on your risk, your age. Where do you wanna go? I mean, you know, somebody that's 70 or 80 is not gonna have the same risk profile as somebody at 40. You know, they have different, you know, they wanna preserve it, they wanna give it to their kids or their grandkids. So they're gonna have, instead of you can go from a 50-50 balanced portfolio, 50% stocks, 50% bonds, to typical asset allocation in a big pension plan, ERISA, is 60-40, 60% stocks, 40% bonds. Somebody that you know is older might have 70% in bonds and 25% in stocks and 5% in cash. So, you know, that's how, you know, we balance out the risk is the asset allocation that you have in the portfolio. I mean, if you want to make more money, you got to put more money in stocks. If you want, you know, a reasonable rate of return these days, you know, you can have a balanced account. A balanced account will always save your butt in one of these type of, you know, markets. So it's a little bit of an education. And, you know, how many of you have been investing in the market for some time? Everybody, okay? So I'm sure you've had some good experiences or some bad experiences. You know, one of the reasons that we're here tonight is to, you know, share with you our firm, our philosophy, and, you know, hopefully, you know, you would trust money with us over time. We run these quarterly, and we do different types of seminars for women with taxes, and we do financial planning, we did an estate planning. So we do these various subjects that help you understand, because some of you, if you live here, your house is worth millions. Okay? It's just a fact. That's a fact. If you're in Palo Alto, you know, your house is worth a lot of money. If you're in Los Altos, it's worth a lot of money. So your estate's worth money just from that standpoint. So, I mean, you might have that, you might have some stocks and bonds, so, you know, it adds up over time, and you might need some help from the estate side. So, you know, we have attorneys that do that, we have accountants, and so that's a little bit about some of the services that we provide you. And, but I'll take some questions if you have some questions. You might have some individual questions that I can answer, and I'll be around too later.
So do you recommend ETFs or just personal stocks?
Well, we do personal stocks and bonds. If you don't have much money, you can go into ETFs because it does diversify. You know, if you buy, you can buy the healthcare sector. It has Johnson & Johnson, and it has Pfizer, and it has Lilly, and it has a bunch of these stocks that we might have, but it has a bunch there. Then you could buy a high-tech ETF that's got Apple and Facebook and Google and stuff like that. So, you know, but they're charging you a little bit of a fee, but you know, that's just we customize it, and we hardly ever use ETFs. We do have some smaller accounts because you might have you know, a large account, and then you might have you know, a $200,000 account over here, or your, you know, whatever, and sometimes we'll use ETFs for that, for a smaller account, just as a service for you.
Are you just in Santa Clara, or are you in other areas, and how many brokers do you have?
We don't have any brokers.
Oh, I
Okay,
meant-
so we're registered advisors, but
Oh.
we have 7 people in Santa Clara is it.
Okay.
So we're local. We have clients all over the state.
So Pete makes all the investment decisions.
Oh.
I'm usually the first point of contact for questions and bringing new clients on board. Yeah.
Yeah.
Okay, so how about I continue here, and then
Absolutely.
your questions? Yeah. Okay, continuing that question on cost. So how much does it cost to own Apple stock in a mutual fund or an ETF? So if you're invested in a mutual fund, and that mutual fund owns Apple, how much are you paying to own that mutual fund, or to own Apple in there?
Multiple fees?
It's gonna, I think I heard the answer, yeah. So there's an annual operating expense for the mutual fund, right? So it might be up to 1%. It's just sitting, which is different from what we do, because if we buy Apple for you, then it's in your account and there's no cost to own Apple. Yep. Make sense? Maybe, did you have a question or?
I was just gonna say management fees, but.
Yeah, exactly. That's what it was. Yep, yep, perfect. Okay, so some important questions to ask if you have an advisor or you're thinking about working with an advisor. Do they operate as a fiduciary? So who can tell me what a fiduciary is?
They put you first.
Yeah,
That's right.
so your interests first,
You know,
not ours.
I've had a problem when I've asked people that. They all say they're fiduciaries, and it's simply not true. So how do you know for sure if they're a fiduciary or not?
Great question. So another way to ask that question, and Pete, you can jump in too, is you can ask the advisor, tell me all the ways that you're paid.
Pardon me?
Tell me all the ways that you are paid.
Oh, okay.
Because I want to make sure you're well compensated for the work that you do, and I want to understand how you get paid. So if you ask me to repeat that question, we'll say that the only way we're paid is from client fees. And so with some advisors, I'm not trying to paint everybody else as bad, because people are not bad and evil. And as we know, it can be complex and not very clear. So Deanna might pay me for being an advisor, and I'm also paid from mutual fund A because Deanna is in that fund that I've recommended.
Okay.
To me, that's what you want to be clear about, is, what's the relationship here? And why are you recommending mutual fund A over mutual fund B? Is there a conflict of interest? I'm suggesting A because I get paid more. So, yeah, makes sense?
So I have a question. So like if you're with a place like Morgan Stanley,
Yeah.
Wells Fargo, or
Yeah.
whatever one of those companies are, so they recommend their mutual funds all the time.
Yes.
So
Big surprise.
they would
huh?
have that conflict, wouldn't they?
They would not have a fiduciary responsibility.
So there's another term called suitability. And
They
so
make a
there's a
commission.
big argument about suitability and fiduciary. So registered investment advisors like us have always operated under the fiduciary standard. The wirehouses, Morgan Stanley, Merrill Lynch, Wells Fargo, have traditionally operated under suitability. Is this suitable for you? Kind of. It also pays me well.
Yeah.
Do you see what I'm getting at?
Absolutely.
Yeah. So it's a good question. You could say, are you fiduciary? Tell me how you get paid. Yeah.
You have to be
They give you
paid by
this
fee.
chart, right, that,
No, it's just,
like different fee schedules for different,
Mhm.
whether you're an A client, or an A investor, B investor, C in the prospectus, but I don't know whether I'm an A, B, C, or D.
right, yeah. Well, anyway,
Huh.
Yeah. The other thing you can check in with yourself and say, does this feel right to me? Does this person feel like they're on my side? Kind of a gut check in about, do I want to work with this person? Is this person trustworthy? Did you want to add something, Pete? Okay. So, here's the same question. So, who of you can tell me how much you're paying your advisor? If you have an advisor. That's a good question. Because if it's not clear,
Well,
Go ahead.
on my account, it depends on how much money is in the account.
Right.
And then it's a certain percentage of that they get 4 times a year.
oh, okay, right. And is it clear to you that they're working as a fiduciary? And
Well, I would hope so.
You hope so,
Right.
yeah, you could ask them.
Yeah.
To me, these are all just good questions.
Yeah.
Because it's a business of trust, it's a people business,
And do they
first
always-
and foremost.
They always tell you the truth.
Well, we would hope. And, we
Yeah.
can't guarantee that, yeah. And like I said, I'm not trying to paint everybody else as evil. There are good people working here, and people come under pressure, and sometimes they do things that are more in their interest than, the client's interest. Okay, this page is way too small font, and it's in the handout that some of you have. And what we say here is that We use Schwab as our custodian. We have $1 million minimum. We'll work with your existing CPAs, accountants, state attorneys. And we manage on what's called a discretionary basis. Any of you familiar with discretionary versus non-discretionary? So discretionary means that basically when you work with us, you give Pete the power to make trades in your account, for us to pull our fee out once a quarter. And if you want us to send money somewhere on your behalf, we'll do that. That's the only thing we can do. We can't, take money from your account and put it in our account. But you are giving Pete the right to make trades. So for example, with the situation like last night, where there was some very unexpected news, Pete can make decisions in the moment. He doesn't have to wait for a phone call to talk with you, Jane, to get approval to make trades. So non-discretionary means the advisor has to call you and say, hey Jane, I think I should buy an Apple for you, is that okay? So it just gives Pete more flexibility to do what's in your best interest. Okay, so the time's moving on, so I'm gonna keep going with the slides here. What do you remember as we're now in the quiz part to see if you were awake and to see if the wine is fogging your brain, okay? So what are some of the benefits you heard from what we offer?
Stocks and bonds.
Stocks and bonds, excellent. Transparency and lower cost individually on stocks and bonds.
I would say direct access. Instead of calling the 1-800 number, being put on hold, being sent here and there and everywhere.
Yeah, like you have time to be on hold for 20 minutes. Yeah. Okay. So that's kind of in there. I talked later on about regular client contact, having somebody you can meet with in person. As we talked about, your bank account is giving you a big zero. Yeah. So to have a strategy that pays some income is helpful. Our income strategy is paying you about 4% right now from the dividends and the bonds. Experienced managers, Pete's been doing this a long time, as we talked about. And I call every client once a quarter after the quarter ends, and I say, hey Jane, wanted to let you know your account was up 2% for the quarter, and we sold Apple and we bought Microsoft, and if you have any questions and you want to meet.
You do anything monthly or is it just quarterly?
Usually quarterly, and it's your money, and we're here to be of service to you, and so I want to keep you happy, and so if you want to meet monthly, that's great.
Send out statements monthly?
We send out statements every quarter, and everything's at Schwab, so you can log in and look at it anytime, the day or night. Also, there's no fixed length on the contract, so you sign up with us, and we pull the fee for the quarter. You decide halfway through the quarter, I don't think this is for me. And we'll send you a refund for half of the fee. We'll say thank you very much and go on.
You do get a statement monthly from Schwab, so you get a monthly statement from Schwab,
Yeah.
and you also get a quarterly statement from us too. So every month you have and you can go online. So it's an open door policy. You can talk to us anytime you want. We're just, we do quarterly meetings and I think that, investing is, over time is a longer period. It's not a month-to-month thing or, week-to-week thing or, something like that. When you're investing for, over time, it takes time to make money. If you wanna go to Vegas, you can do that right away. You can either lose it or make it. So, but, good investments take time. It's like real estate, it takes time. Your house wasn't worth, what it was, 20 years from now, it's worth a lot more than where it is today, correct? So if you held stocks over time, good ones, they make you money.
Okay, so which of these assets do we use when we make a portfolio for you?
Individual bonds and individual
Oh,
stocks.
Correct.
very excellent. You smart bunch here, huh? Okay, so which of our portfolio strategies is the most popular one? Before I showed you.
You said the income strategy.
Income strategy in the back row. Okay, and what kind of assets do we have in that portfolio?
Stocks.
Stocks and bonds.
Dividend paying stocks and corporate bonds. And how much income are you getting from that strategy right now? How much?
Not much.
So
Well,
4%.
not much in your bank, but in our income strategy, about 4%.
Okay.
So that's the interest, the bonds are paying you interest every 6 months. And then the dividends from the stocks, so from Apple or Disney or AT&T, yep. Nice thing about the dividend paying stocks is you're getting paid while you wait. Get this dividend every 6 months, and eventually the stock will rise and then you get them.
Do dividends are normally paid every 6 months, or does it vary on
Quarterly.
stock?
Stocks are quarterly, the bonds are every 6
Yeah.
months.
Did you have a question, Diane?
No,
Good job.
no,
Okay.
no.
Trying to read the fish and expressions here, so. Do we do financial planning? Yes! Remember that software? Yeah, yes. Do we have audited performance?
Yes.
Yes. Are we checking off all the boxes on your checklist? Okay, who's our typical client? And Schwab, yep. And Pete talked about preservation of capital. Often we work with retirees who are looking to preserve their capital and grow it conservatively. We have some younger clients as well. Okay, what's our minimum investment size?
1 million.
1 million. 2 million for bonds. And what's our fee?
1%.
1%.
1%. Yeah, and then declines with more assets. Okay, next slide is you, Pete, on stock selection, and I wrote today's market, which I didn't really know that today's market was gonna be quite so eventful.
Well,
So-
this is, our stock selection, we do a lot of, we do the research ourselves, and we use research from various different warehouses. Also, we use technical information. So, and there is a pretty good research that we do into the investments when we're doing them for you for both stocks and the bonds. But basically, when you give us money, you say you give us $1 million. I mean, we'll have a bunch of different stocks in there. What you looked at the bottom is you take your statement. I gave you $1 million. How much is it worth? And how much is it growing? What we do in between is that's what's our job is. You hire us to manage the money. So we report to you just like we report to the investment committee at the foundation or the church or someplace else. So that's we usually use about 35 to 40 different stocks in the portfolio, and the bonds vary from the account size, how many we put in that, but it's usually anywhere from 10 to 20 bonds.
Perspectives.
This gets a little bit more technical.
Yep, well, valuations, deal spread. Everything kind of changed last night when you said that.
Yeah, I mean, some of you have been around a lot longer. You've seen a lot of different presidents. This should be interesting because you have someone who's Republican, the Senate's Republican, and the House is Republican. You haven't had that since the 40s or the 20s. So, now's the time that they could really do some good things for the economy, for the citizens, reduce the debt that these guys have been basically spending our money and running up the debt. So, fiscally, I'm very conservative, socially, moderate, but I think that the debt could be a very, big problem down the road for the U.S. And low interest rates, staying in a low interest rate environment has inflated the real assets quite a bit. So, and what it's hurt is retirees and pension plans and insurance plans. So you will see interest rates start to go up over time here, which will help out. Because in the old days, you could get 4 or 5% in CDs. You can't get that anymore. So, but if you have any other questions on the markets today, they're volatile. So that's why you need, whether you need somebody like ourselves or somebody, another pair of eyes, at least on your assets over time.
And last slide.
Thank you.
Thank you very much. I really appreciate each of you coming here, spending an evening with us. I hope it was helpful, enjoyable. I'm gonna be around for a few minutes.